different volatility characteristics do exist, it's easier to identify them in retrospect than in the moment. And in the moment, our biases toward staying the course, toward a belief that everything will revert back to normal, toward a desire to hold on to the comfortable old benchmarks, mean that we're likely to continue to behave as if the old benchmarks were still in place even after they have actually been superseded. They call them anchors for a reason. This means that when, eventually, the old benchmarks that have remained the foundation of expectations for the future are finally replaced, change will arrive not only with the volatility of these new circumstances themselves, but also with the additional force of pent-up denial and delay. The history of Bill Gross and his new normal formulation is a good case study of this process at work, with all the frustration that comes from not only being right, quite likely, in my opinion, but also way too early. History tells us that the grander the theory, the bigger the big volatility moment that it is trying to forecast, the harder it is to forecast when that big volatility moment will arrive. Which leaves us with a practical problem as well as an intellectual conundrum. The grander the theory, the more profound the potential change and the greater possibility for profit, or the greater the need for protection from this big change. But at the same time, the grander the theory, the harder it is to project when the big volatility moment will arrive. That suggests, to my mind, a need to try to match the timing uncertainty of the big volatility moment with the longevity of the kind of options for volatility that you use in a portfolio or in everyday life. An option that expires in 90 days, as most purely financial options do, is much less useful in the case of a big volatility moment than an option such as an ownership bet on the future of a stock. That, in my opinion, is the crucial volatility lesson from this episode in financial market history. This new normal doesn't seem all that radical or threatening, although cumulatively it is. Instead of nominal, that is, including inflation, global GDP growth rates of 6 to 7% driven by the world's emerging economies, in the new normal, investors can expect, Gross said, nominal growth rates of 3 to 4%. The return on assets will be half of what it has been over the last 20 years, both because of this lower rate of economic growth and because of the need to deleverage global economies and the global financial system after the excesses of the bubble that led to the global financial crisis. That translates, according to the new normal, into average annual returns of 5% on equities. That's a huge drop from the 10.5% annual return that was the benchmark for investors and Wall Street for the lifetime of the children of the bull market. And bonds won't do any better. With the U.S. deficit rising and with trillions in assets on central bank balance sheets that need to be resold to private markets, the new normal says global and especially U.S. interest rates will need to climb to keep attracting foreign money. This will be especially the case in the United States, as the U.S. dollar will be in decline, making dollar-denominated assets less attractive and requiring higher interest rates to attract overseas money. So don't count on the traditional 5% average annual return on 10 to 30-year U.S. Treasuries. How about 2% or 3%? And remember that this return includes inflation. If you think inflation will run at 2% a year, at the lower end of the benchmark range, bonds are only breaking even. Unfortunately, the next few years after his 2009 pronouncement didn't prove Gross right. In 2009, the S&P 500 returned 26.5%. In 2010, the return was 15.1%, and in 2011, 2.11%. The returns on the 10-year Treasury started off in 2009 looking as if the data would demonstrate Gross's new normal. That year, 10-year Treasuries lost 11.1%. But then in 2010, they returned 8.5%, and in 2011, 16%. At best, Gross was early. And early, when you're trying to make money on a change in a big volatility trend, isn't really all that different from being wrong. Which led Gross to double down in 2012. By 2012, Gross had become even